balances. The following balances were recorded in the books of account on 31st March 2015. Okay, so we've got all this information here. Okay, and then we have this additional information. Yeah. All right. So when you're dealing with financial statements, questions with financial statements, you always need to start with your additional information, okay? Because there are some adjustments that you need to make from this information here. All right, so we're going to look at each of the adjustments, and we're going to see what happens. Then once we're done with the adjustments, then now I'll explain to you what each financial statement is, and we're going to make those financial statements. So first thing here, we're going to deal with the adjustments, the additional information. Okay, so first things first, we've got closing inventory of 14,200. So this closing inventory, colleagues, you're going to see it both in the trading account and the balance sheet. Okay, so you just leave it as it is for now. Okay, you don't do anything with it, you just leave it as it is. Next, we've got 6% bank loan that was taken out on 1st July 2024. Alright, so here we have a bank loan. We got it on 1st July 2024. We have to now find out when does our year end. It tells us our year ends on 30th April 2025. So what we need to do, colleagues, we need to find out, okay, how much interest expense do we need to pay for this year until the year ends? From the time we got the loan till the time the year ends, how much interest do we need to pay? I hope we're clear with that, okay? We're trying to determine how much interest do we need to pay from the time we got the loan until the year end. Okay, so the first thing that you need to do, okay, first find the yearly interest expense. Okay, so you're going to say 6% of 30,000 kwacha, because remember on the trial balance here to the 6% bank loan, 30,000. So this is the interest rate, 6%, and the amount is 30,000. So you find out what is the yearly charge. So 6% of 30,000, that's 1,800 kwacha per year. That's how much interest we need to pay per year. Okay. Now, from the time we got the loan until the year ends, it's not a full year. Okay, it's just some months. So we need to find out, okay, now what is the monthly expense? The monthly expense, 1,800 divided by 12, 150 kwacha per month. Okay, so that's how much interest we have to pay per month. So once we found out how much interest we need to pay for the month, we're going to ask ourselves, okay, from 1st July 2024 to 30th April 2025, how many months is that? Okay, so you count now first. Okay, you've got July, August, September, October, November, December, January, February, March, then April. We're including April. Why? Because it says 30th April. If it said 1st April, you are not going to count it in. Okay? So you count how many months? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So it is 10 months. Okay? So that's the interest we need to pay for that year for 10 months. Since we got the loan in July, so we need to pay interest for 10 months. Okay? So since the monthly charge is 150 kwacha per month, we're going to multiply 10 months times 150 kwacha. This is 1,500. Okay? This is how much the interest we have to pay for these 10 months. From the time we got the loan till the time the year ends, we're supposed to pay 1,500. Now if we look on our trial balance here, where is that interest paid? Yes, bank loan interest paid. Have you seen? We only paid 900 kwacha. Okay, we're supposed to pay 1,500, but we've only paid 900 kwacha. So it means we are owing. Okay, so how much are we owing? We're supposed to pay 1,500, but we only paid 900 kwacha, so we're owing 600 kwacha. Okay, so this 600 kwacha is our accrued expense. Okay, this is an accrued expense. So before I proceed further, any questions? Okay, so this is how you deal with accruals. Okay, whenever you have an accrual, this is the journal entry. You don't need to put this journal entry in your workings. I just want you to see the full picture. They put yes. This is the journal entry. Okay, you debit this 600 to the interest expense. So in the statement of profit or loss, we need to add this interest expense. Okay, the statement of profit or loss, you need to add this interest expense, which I've done here. 900 from the trial balance plus 600 the accrual. So our interest expense that should be on the statement of profit or loss is 1,500 kwacha. Okay, then since we haven't paid this money, it's a liability. Okay, so you can call it accrued interest or interest payable. Okay, so this will be in your balance sheet as a current liability, this 600 kwacha. So the rule to remember is whenever there's an accrual, add that accrual to the expense in the related expense in the statement of profit or loss, and include the accrual as a current liability. Any questions? Okay, that's adjustment 1. The next one, marketing costs include 6,000 for a promotion running from 1st February to 31st July. Okay, so as you can see, this promotion is from 1st February to 31st July. So we find out, okay, for how long is this promotion running for? Okay, so you're going to count how many months it is from February to July. So February 1, March 2, April 3, May 4, June 5, July 6. So this promotion is running for 6 months. Okay, so we paid for it on 1st February and it's ending on 31st July. Okay. So now with this one, this is a prepaid expense. Okay, because this expense we paid it in what's this, February, and it's crossing over our end of year and moving into the next year. So what you need to do when you have a prepayment, first find out how much of the prepayment has been used up for the year. Okay, find out how much of the payment has been used up for the year, and then determine how much is also that has been prepaid. Find out how much has been used for the year and find out how much has been prepaid. So we come again here. So from 1st February to 31st July, 6 months. So we say, okay, what is our monthly charge? 6,000 divided by 6. It's 1,000 kwacha per month for this promotion. Okay. So now, first we're interested in the amount that has been used up for our year. Okay. So you're going to say, we paid for this in 1st February and our year ends in 31st April 2025. So we've used up 3 months. Okay, we've used up 3 months. So how much is this that we've used up? We say 3 times 1,000, 3,000 kwacha. Now for the remaining 3 months, that's going to be a prepayment. Alright, because remember we paid in February for 6 months, so only 3 months have been used. The remaining 3 months, that's going to be regarded as a prepayment. Okay, when you pay for something in advance, that is called a prepayment. Okay, so this 3,000 used up. So now I have to find out, okay, now how much is the prepayment? So if we paid a 6,000 and 3,000 has already been used up, the prepayment is 3,000 kwacha. Okay, this is the prepayment, 3,000 kwacha. Any questions before I move further? So whenever you incur a prepayment, this is the journal entry. As I said, these journal entries you don't need to put them. Debit the prepayment because it's a current asset. Remember, according to the double entry rules, assets increase with debit. So you debit the prepayment here. This means on the balance sheet, it will be a current asset. Then you credit the expense. Okay, you reduce the expense. The reason why we're reducing the expense, because we only want the expense that has been incurred for the year. For the other year, we don't want it. Okay, so you credit marketing costs. All right, to remove the cost. Okay, so we're going to credit marketing costs, meaning this credit entry here means our marketing costs from our trial balance is 14,400. So 14,400 minus 3,000, we get 11,400. So this is the amount that must be on the statement of profit or loss. Okay, we've removed the prepayment from there and put it as a current asset. All right, and we just kept the part of the expense that was used up during the year. Any questions? So this is the general rule for prepayments. Okay, prepaid expenses. Subtract from the expense in the income statement and include as a current asset in the balance sheet. So please remember these two rules for prepayments and accruals, because they will always come. They never miss out. You don't need to do the journal entries, what I've done there. Just remember, an accrued expense, add it to the expense in the income statement and include it as a current liability in the balance sheet. Prepayments, subtract from the expense in the income statement and include it as a current asset in the balance sheet. Okay, excuse me. So please remember those two rules. Okay. Okay, so here power owing 1,400, water prepaid 600. So here power owing accrued expense. So colleagues, what are we going to do? We've got an accrued expense. What are we going to do there? Colleagues. I'm just from explaining. What are we going to do with this 1,400 and what are we going to do with this 600? Remember, just trying is part of learning. Okay, if you get it wrong, you just understand that, oh, okay, next time I know what not to do or what not to say. My colleagues, you know what's the disadvantage of remaining quiet?
No.
You don't get to learn. If you remain quiet, you run the risk of not learning anything. So madam, could you try?
So the 1,400 put it under the expenses.
Meaning, what will we do? Will we add it to the would we add it to the power expense or subtract it?
We add it to the power expenses.
Correct. Yes. Correct. Then the prepayment. And the prepayment.
Mr. Roy, can you try to answer that one?
let's see who's in the class first. Mr. Peter, Madam Nama Lambo, I hope I pronounced it correctly.
The one who just answered about the other question.
Okay. Madam Doris, remember colleagues, wrong answers are okay, alright? Everyone who has ever got an A+, they've answered wrongly before in class. But people who have got D's and C's, they're the ones who are quiet in class. So it's up to you. Do you want to have a or a B or a C? Or do you want to just have a normal C? Okay, colleagues, the prepayment you subtract, okay? You subtract, alright? So maybe let me write the journal entries again here. So for an accrual, remember, I hope we have those tables, those tables I showed you where the double entry rules. For an accrual, you debit, okay, you debit the power expense 1,400. Okay, so meaning we're going to add 1,400 to the power expense. Okay, this debit entry means you're adding 1,400 to the power expense. Then the accrual, okay, 1,400. This is where we say the accrued expense is a current liability in the balance sheet. Okay, this debit entry, add this credit entry, include it in the balance sheet as a current liability. Any questions, colleagues? Because we were Z when it came to this one, but I was from explaining. So any questions? Let me start. Mr. Peter, any questions so far? If I'm moving too fast, you can let me know, sir, you're moving too fast. Okay, let's move at a slower pace. Okay, Madam Chikonga, any questions?
No questions, sir.
Madam Doris? Madam Caroline? Or Madam Carol? Okay, wonderful. So please remember that. Then for the prepayment, you debit 600. I think the prepayment was 600. Yes, 600. This debit entry signals that you're including it as a current asset in the balance sheet. Then you credit power. Okay, since it's a prepaid expense, it's relating to another period. Okay, remember, colleagues, the matching concept. According to the matching concept, okay, revenue and expenses should be recorded for the same periods. So here we're only focusing on the revenues and expenses for this this actual year, which ends in 30th April 2025 for this company. Okay, we only want the revenues and expenses for this year. That's why you've seen the prepayments, we're removing them, because that expense we haven't incurred it yet. So that's why we're moving them out. Okay, that is the matching concept, or the matching principle. Record revenue and expenses for the same periods. So this here we're talking about the period from 30th April 2025 and below. Okay, that is the matching concept. Then another concept, accruals concept. Okay, whenever you earn or you earn revenue or incur an expense, record accruals concept. I hope we've remembered those two concepts, matching concept and accruals concept. Okay, so that's why you're seeing we are removing these prepaid expenses because they are relating to other years. Okay, anything that's relating to another year, even for the interest, remember we only accounted for 10 months. The remaining 2 months they are regarding the next financial period. Okay, because we just want only focusing on revenues and expenses for the year. I hope that is clear, especially if you're doing accounting and finance. I pray that is clear. Okay, I pray. If you're doing HRM and human resource, you just need to know it for this year. Okay. Next, a delivery vehicle costing 18,000 with accumulated depreciation 14,400 was sold for 5,200 cash on 20th March 2025. No entries have been recorded. Okay, so here we're now dealing with asset disposal. Okay, whenever you get rid of an asset. Okay, so remember, depreciation is the loss in the value of an asset. Okay, so each year you incur a depreciation expense. The accumulated depreciation expense, the accumulated depreciation is going to be increasing every year. Whenever a new depreciation expense comes in, the accumulated depreciation increases also. Okay, the general entry for depreciation here, yeah, so power and water expense, just add plus 1,400 accrue, subtract in prepaid expense. Yes, now yeah, we're here on the depreciation part. So every time, every year, this is the general entry for depreciation. You always credit the depreciation expense. This is the one you see in the income statement. Okay, you always credit depreciation expense, and then you credit provision for depreciation or accumulated depreciation. Which word did they use in this question? Accumulated depreciation. Okay, other books you see it as provision for depreciation. Provision for depreciation is a contra asset account. Okay, it's a contra asset account. Okay, whenever you hear the word contra, it means it reduces. Okay, if you hear the word contra, just know it reduces something. Right, so a contra asset account reduces the value of an asset. Okay, so each year when you're doing this depreciation expense, the accumulated depreciation is growing, and as the accumulated depreciation grows, the value of the asset drops. Okay, so when an asset has been sold, you need to find out how much is the asset worth, because there was depreciation, so it's not the same value as you bought it. Okay, so you have to find out, you have to ask yourself, okay, how much is this asset worth right now? All right, so this is where we bring in the net book value or carrying value. Okay, the net book value is cost of asset minus accumulated depreciation. Okay, once you subtract the cost from the accumulated depreciation, you're going to get the value of the asset. Okay, you're going to get the value of the asset. So cost 18,000, accumulated depreciation 14,400. So the value of the asset is 3,600. Okay. Now this asset for 3,600 was sold for 5,200. Okay. The asset worth 3,600 was sold for 5,200. Okay. So we have to find out our gain or loss on disposal. Okay. Anytime you hear an asset has been disposed of, okay, just tell yourself, I have to find out, was there a gain or a loss when disposing this asset? So if you get a positive value, there was a gain. If you get a negative value from this formula here, there was a loss. Now before I move further, any questions so far? Okay, remember, my aim is not to cross, okay? It's to take time. Okay, wonderful. No questions. So, where were we? So, yes, gain or loss on disposal, it is cash minus net book value. Okay. So the cash that was sold, we sold this for 5,200, and the net book value 3,600. So it's like we've made a 1,600 as profit. Okay, so this is what we call gain on disposal. Okay, we have made a profit from the sale of this asset. Okay. So remember, since money was paid 5,200, you need to include it. You need to add this 5,200 to the cash balance on our here. You need to add that 5,200, the cash balance. Yes. Which we're going to do here. 15,740 plus 5,200, 20,940. Our colleagues have got